I am Camilla Jeffs, CEO and founder of Steady Stream Investments. And today this is our another part of our investor education series. And we're talking about the risks. So we're talking about the scary stuff. What are the risks that are involved, and how can you mitigate those risks? What are some strategies that you have to be able to not worry so much about those risks? I don't know about you, but I'm a big worrier sometimes, and sometimes the risk seems to be really big. So, just to start off with, just a quick intro. Steady Stream Investments is a company that is an education focused company, and we help you build wealth by investing passively into multifamily syndications. And syndications is just fancy word for group investments. So we put together a group of people. We all go out and we buy a multifamily property together, and it really helps you have that financial peace of mind. For me, I'd want to have safety and security. I like to have financial peace, and then you also be able to leave a legacy for your family if that's something that you want to do. So today, what are you going to learn? You're going to learn about passive investing. So what even is it? Then we're going to go dive into the three biggest risks to investing passively in real estate. And then we're going to talk about how to really to mitigate those risks and what are some strategies that you can do as a passive investor. So, what even is passive investing? I'm sure if you hear about real estate investing, probably the first thing that pops into your mind is someone that goes out and buys a fixer-upper. They fix it up, they put tenants in there, they become a landlord, and they have to deal with toilets and all sorts of horror stories. I'm sure you've heard them. And I've lived some of those horror stories through doing single family investing. But when I found out about passive investing, most of my single family investments were a lot of work. And passive investing, though, is very different because when you join a group, you can actually rely on someone else to do the work for you, which is fantastic. So it's totally passive, right? You don't get calls from property manager. You don't have to screen the tenants. You don't have to file any paperwork. Someone else does all the heavy lifting, and you simply invest your money into the deal. And that's really fantastic about passive investing. It's kind of a set it and forget it. Okay, so let's figure out the biggest risks to investing passively in real estate. So, risk number one is a capital call. So, what's a capital call? Well, when the operator or lead sponsor has a situation where essentially they run out of money, right? So they've gotten to the point, maybe the property that they purchased in the beginning was only 60% occupied, and the business plan was they're going to get it up to 90% occupied. Well, they buy it and things go okay, but it's not really going along according to plan. And they have not. And so by month 6, they have not gotten it up to 90% occupied. And suddenly there is a big repair that needs to happen. So sudden all the AC units start going out, just one after the other, after the other, after the other. And we've experienced this where we didn't realize that the AC units were that old. Well, now they don't have enough money in their account to cover all of those AC units because one, they didn't raise them on enough money in the beginning to have enough reserves. We call them reserves that you keep in your account to cover any unforeseen circumstances. So that's a risk. So what they would do in that situation is they would go back to you as the passive investor and they would say, hey, we ran into this situation. We really need your help. We're all in this together. We need some more money. Could you please put more money into the deal? Now, if you do put more money into the deal, you would receive a return, right? So the sponsors would again tell you what the return would be on that new money that you put into the deal. It's not that you're just putting the money into the deal and you won't get a return on that, but that is a risk of investing passively. Okay, risk number 2 is distributions. Sometimes the operator runs into a situation where they have to stop distributions. Well, can anybody think of a time that might have happened recently? Yes, COVID, right? So COVID struck in March of 2020, and the deal that I was invested passively in, they did halt their distributions. And almost every one of my investor friends who had syndications like this did the same. So they halted distributions through almost all of 2020. So that's a risk that you have to be aware of, that there might be situations like, of course, the pandemic was crazy situation, and none of my investor friends had ever had to halt their distributions until that happened. But what they needed to do is they wanted to make sure they didn't run out of money, right? So they halted their distributions before they ran out of money so they didn't have to do risk number one, which is the capital call. So it's something that could happen in a situation. So be aware of that, because if you are investing for cash flow and you are trying to live on that cash flow, just be aware that there could be situations in which distributions would be suspended. All right, risk number 3 is the business plan. So every investor, we go into these properties and we evaluate them, we do our due diligence on them, and we look at them and we say, okay, here is the things we are going to do to make this asset worth more money. And to make an asset worth more money, you can do one of two things. You can increase the revenue, increase the income on it, or decrease the expenses. So when we figure out that we're going to buy an asset, we put together a business plan. And we say, sometimes it's we're going to renovate all the units and then we're going to raise the rents. Sometimes it's, well, the property management company has done a really bad job. The seller hasn't really cared about the property for a long time. The expenses are really, really high. So we're just going to go reduce those expenses. And sometimes in the case of a property that we are purchasing right now, is that the rents have appreciated so fast in that market that now all we have to do is just put the rents back up to market rent because they had fallen behind. So those are some of the things that you can do for a business plan. But the risk here is that either the operator doesn't successfully execute the business plan, so they don't stay on top of it, right? If there's 100 units to renovate, well, do they do one at a time? Do they do 10 at a time? Do they do 50 at a time? Like, what's the right cadence to do to renovate the units? And so also, there's always going to be obstacles. There's always going to be unforeseen events that happen. And so sometimes the operator would have to significantly change their business plan. So just know that that is a risk, that a business plan could change from what they were doing in the beginning. So let's talk about now how to actually mitigate these risks. So what are some things to do? And what are some things to look for as a passive investor so you can, be careful so that these risks don't happen? Well, number one is to invest in an asset that's cash flowing from day one. If you invest in, so more risky investments are going to be those that are maybe only 50% occupied. Those will not be cash flowing from day one. Now, if you're an investor that is comfortable with that type of risk because the reward is going to be higher, remember there's a a risk reward ratio. Just know that that is a risk that you're going to be facing. So if you don't like that type of risk and you don't want to have these other things that happens like capital calls or you're not getting your distributions, you really want to look for assets that are cash flowing from day one. Okay, the second thing that you can do is leverage. So investing in a hard asset, right? Banks want to lend on commercial commercial deals. So they love commercial deals. And you know why? It's because they are more run like a business than they are like a single family rental. I don't know about you, but the last time I tried to go and get a single family rental, I almost felt like I had to birth a baby because there was so much information and paperwork and things that I had to go through to get that. It's actually much easier to get lending on a multifamily 100-unit apartment complex than it is on a single family rental right now. Because banks want to lend on them. They know that they are really great assets and they're going to give us the best loans and the best leverage that we can do. So you want to make sure that the leverage, however, is not too high. So that's another issue that could happen. So when you're looking at these deals, one of the questions that you could ask the sponsors is, what is the loan to value ratio, right? And you want it to be 75%, maybe 80, but no higher than 80. Right? You want to have that ratio to be no higher than 80% so that you know that they can pay the mortgage payment, right? That's it. It will be lower risk if it's 80% or less. Okay, number 3, appreciation. So if you invest in a property that has the potential for really high equity growth, then that will help to mitigate all those risks. So, for example, if you're investing in a market like Phoenix, Arizona, they are growing like crazy, really high population growth, really high job growth, really great job diversity happening, and it's a really nice landlord state. So, investing in strong markets like that have all four of those components really helps it's more forgiving for any mistakes that might be made along the way. So as long as there is potential for appreciation, then that will really mitigate those risks. Okay, number four, tax benefits. So you're mitigating risk by investing in real estate that has multiple tax rewards. And we do this in commercial multifamily. The really nice thing about being a passive investor is that although you're not managing the property and taking care of it and doing all the, pounding the nails and things like that, you still are a direct owner in the property. And therefore, you get the tax benefits passed directly onto you that the government gives to us. So it's really fantastic. So that really helps mitigate your risk. So if you think about your cash flow and those, like if distributions stopped for some reason, you're still going to get the tax benefits from this property. And so overall, you should be okay. And then finally, the biggest one, this is the biggest one, I can't overemphasize this, is the experience factor. You really need to invest with a team who has a strong background in real estate, who has done this before. They have the been there, done that factor. And they have seen the challenges, they have been through the challenges, and they're not they're not brand new to real estate. They are really there and they know what they're doing, and have really strong ethics and morals and a very good communication as well. So I wanted to throw in one more bonus risk that I get asked actually pretty quite often. And that's then people say, Camilla, is there a risk I could lose all my money? And here's the truth. Yes, right? Yes, right? I'm not going to sugarcoat it. It's every investor's worst nightmare that they'll lose all their money. And that is a risk that you face, right? In any investment that you put your money into, you risk losing it all, right? Even in the stock market, and in real estate, in crypto, in anything you want to invest in, you could risk losing it all. So, how do you mitigate that though? Well, like I said before, invest with experienced teams. Experienced teams don't lose investor money. In fact, they will lose their own money and lose all sorts of things before they would lose investor money. They want to make sure that they are prioritizing their investor money. Okay, number two, you buy a cash flowing asset as is. As is meaning that regardless of if you have to renovate it, it's still bringing in cash. And so there's not much risk there that to be able to lose money, because if it's already bringing in cash, there's not a lot of risk to lose the money. Okay, invest in growing markets. I said this before. Make sure that you're choosing a market that is growing. You don't want to choose one where people are moving out of. And if you study migration reports right now, there's a very clear migration happening from the north to the south, right? A lot of people are moving out of the cold states and they're moving down to the warmer states, which is where you would want to really look at the market. Now, does that mean that you can't make money in northern states? No, you could make great money. You could invest in the northern states and absolutely you could make money. You just have to take a really hard look at those markets to see if they are growing, and it just helps to mitigate the risk. Another one is to use conservative underwriting, meaning that whenever the underwriting is just a fancy word for financial analysis. If there's a financial analysis on the property, you want to make sure that they have done that really conservatively, that they're not saying, oh yeah, we can totally raise the rents by $500 a door. And we can, and the market's going to grow 20% year over year over year. That's a bit crazy, right? You want to see more conservative underwriting that says, well, we could probably get to $200 more per door, but we're going to shoot for 100. And we could probably, the market is actually increasing by 6% every year. But to be conservative, we're going to put 3% because we really don't know what the future holds. That's the type of underwriting that you want to see on these properties. And then the last thing you can do to mitigate the risk of losing your money is to invest with cash. Like, don't take a loan to invest into one of these syndications. I always encourage investing with cash. so that, if you lose your cash, you're not in a extra bad situation if you had taken out a loan. Um, but other thing I want to say is this is probably the biggest risk, right? Is losing your money. But what we do is when there's a multifamily property, we put it under an LLC. An LLC stands for limited liability company. And with a limited liability company, that means it's kind of self-explanatory. It means your liability is limited to only the money you invested. So say you invested $50,000 into the property. The worst thing that can happen is you lose that 50,000, but you couldn't lose anything else like your house or your other cash accounts or your stock market accounts or other investments that you may have, because you're protected within that limited liability company. So I know risks are scary, and every time we look at an investment, you have to assess the risks. But we all know that you cannot become a millionaire by putting your money into a guaranteed CD, right? It's just not going to get you there. And if you have that goal, to really build the wealth that you need for retirement, and we all pretty much know that we need at least $1 million to be able to live, to be able to retire in this economy. Then you want to take into account what type of risks are you willing to take to get there. Okay, so a couple of questions that you can ask. So I put together a list of 8 questions that you can ask to kind of reduce the risk factor on these investments. So number 1, what's the business plan? You want to know what the business plan, what are they going to do to really make this asset grow? And do you think that makes sense? Does the business plan make sense, or is it pretty risky? And number 2, is the market high growth? Again, ask them about the growth of the market. 3, what does the underwriting look like? Get to know the numbers. And I know sometimes as a passive investor, you don't really want to deal with all the numbers as much. But it's important for you to understand those numbers and understand if they are being conservative or if they're being kind of aggressive on their underwriting. Number 4, what's the exit plan? Sometimes it's good for teams to have multiple exit plans instead of just one exit plan. So if you think about an exit plan in a multifamily property, one of those could be to sell to another investor. Another exit plan could be to sell to a REIT, for example, or an institution that would want to do it. Another exit plan could be to do a refinance, and maybe they're just going to keep it and keep going with it. You'll need to understand what the exit plans are. 5, what's the operator's track record? How long have they been in business? How many deals have they done full cycle, which means they bought it, they put their projections on, they used investor money, and then they sold it after several years. And what was the difference between what they projected that they were going to give investors and what they actually gave investors at the end when it's sold? That's an important thing to know. Number 6, what's the investment timeline? Majority of the investments are projected about 5 years, but sometimes you'll see some that will say, oh, it's a 2-year deal. Well, if it's a 2-year deal, you would want to understand, well, what happens if you don't sell it in year 2? What happens if you can't sell it in year 2 or year 3 or even 4? What are you going to do there? Number 7, what is the break-even point? The break-even point is the point at which the occupancy and the revenue from that occupancy equals all the expenses plus the mortgage payment, right? And so that's the break-even point. Sometimes that is, well, it has to be 70% occupied for us to break even, meaning that we won't be losing money. Sometimes it's 50% occupied. That's an awesome deal. If you see one like that, go for that one. But typically we see break-even points around the 70%. But if break-even point is 90%, that's a risk. That's risky there. And you would want to stay away from one like that. And then number 8, what's the communication plan? I think as a passive investor, probably I felt a lot of anxiety about, well, what if they take my money and they never talk to me again? And the money goes into this and it says it's supposed to be doing, but I never hear from them. I have no idea what's going on. I'm just in the dark. I think that's more scary than actually losing your money because you're just panicking about, well, what's going on? So make sure that you talk to the sponsors and understand their communication plan. Am I going to hear from you monthly, or is it quarterly, or are you just going to call me when you sell it in 5 years? Like, and what is your comfort level with that communication plan? So that's it, short and sweet. If you have any questions, please type them in the chat box and I'd be happy to answer any questions right now. And then if you are ready to learn more, right? At Steady Stream Investments, again, we're a super education focused. We just want you to understand what you're getting into and also understand the amazing benefits that joining a group investment can really give you. It's pretty fantastic. And it's fun for me to talk to investors and to see their light bulb moment and like, wow, this is pretty awesome that I can invest and get these types of returns on a hard asset. I love real estate because we can touch it and feel it and see it and just drive by it whenever we want to. So a couple of things we offer at Steady Stream Investments. I have a weekly newsletter where I share kind of insightful tips to really help you succeed in real estate. I have a free masterclass called Passive Investing Made Easy. It goes through all the from A to Z, everything that you need to know about investing in real estate syndications or group investments. And then I also have a couple of free guides to get you started on your journey. So you can get those at camillajeffs.com. Okay, so I'm going to jump to the chat right now and see if we have any questions. And I did have one that was submitted. It says, what if I need my money back? Right? What if I put my money into a passive investment and a year later I have an emergency? Maybe I have a major medical emergency and I'm hurting for cash. What if can I get my money back? So this is another risk that you have to be aware of, is that typically these deals are what's called illiquid, meaning that you can't just simply get your money back, right? The money goes into the deal and is held in the deal until it is sold. Of course, you'll get your distributions and you can use that money for other things. So just keep that in mind, that it is for the most part illiquid. There is a way to get your money back if you absolutely need it, but the only way to do that is if someone else bought out your share of the investment, right? And so the other investors could do that for you if they, if we needed to, or a general partner could do that for you. But just know that you should just plan on that money staying in the investment. This is long-term investing. This is not short-term investing. So if you think you're going to need your money in a year, then make sure you don't invest, right? That would be a reason to not invest into one of these deals. Okay, so that's the end of our presentation. Again, thank you so much for joining me today. And if you're watching this on YouTube, be sure to subscribe and share this with anyone you know that may be looking for another investment opportunity. Appreciate you all being here and have a fantastic day.